You got a raise this year. Maybe 3%, maybe 5%. Your boss shook your hand, HR sent an email, you felt good about it for about a week. Then you went grocery shopping. And somehow, with more money in your account than last year, you still felt broke. The rent went up, the food bill went up, the electricity bill went up, the car insurance went up, everything went up. And your raise, the one you waited 12 months for, barely moved the needle. You were not imagining it. You were not bad with money. You were experiencing something that has been quietly engineered into the financial system for decades. A gap between what workers earn and what life actually costs. A gap that started small and has been widening consistently, deliberately, structurally ever since. Here is the part nobody explains clearly. Your salary was never designed to beat inflation, and the people who designed the system knew exactly what they were doing.
Let us start with a number. In 1971, the average American worker's salary could buy a house, support a family, run a car, and still save money. On one income. One income. Today, in most major cities, 2 incomes struggle to cover rent. That is not bad luck. That is not laziness. That is 50 years of a very specific economic policy playing out exactly as designed. Here is the simple version of what happened. In the 1970s, inflation spiked dramatically. Oil shocks, supply disruptions, money printing after Nixon ended the gold standard. Prices rose fast. Wages tried to keep up. Workers demanded more, companies paid more. Prices rose again, wages rose again. Economists called it a wage-price spiral, and the people running the financial system decided it had to be stopped. Their solution, engineered by the Federal Reserve under Paul Volcker in the early 1980s, was brutal but effective. Raise interest rates to nearly 20%, crash the economy, spike unemployment, break the back of worker bargaining power. It worked. Inflation came down, but something else came down with it. Something that never fully recovered. The relationship between productivity and wages.
Here's the thing that should make you genuinely angry. From roughly 1948 to 1973, productivity and wages moved together almost perfectly. Workers produced more, workers got paid more. Simple, fair, the deal that built the middle class. Then, starting in the mid-1970s and accelerating through the 1980s, the lines separated. Productivity kept rising. Wages stopped rising with it. Since 1979, American worker productivity has increased by over 60%. Real wages, wages adjusted for inflation, have grown by less than 20% over the same period. The workers got 60% more productive. They got paid for 20% of it. Where did the other 40% go? Profits, shareholders, executive compensation, financial asset appreciation. In other words, the people who own things, not the people who do things. Think of it like this. Imagine you and your employer are baking bread together. Every year you get better at it, faster, more efficient. You bake 60% more bread than you did 20 years ago. But every year, your share of the bread gets slightly smaller.
Not dramatically, not all at once, just quietly. A slice here, half a slice there. After 20 years, your employer has most of the bread. And when you point this out, they say, "Look, we gave you a 3% raise. What are you complaining about?" That is the productivity wage gap. And it is the structural foundation of why your salary will never beat inflation. But there is a second mechanism, and this one is even more insidious. It is called asset inflation. Here's how it works. When central banks cut interest rates, which they did consistently from 1981 to 2021, cheap money floods into the economy. That cheap money does not flow evenly. It flows into assets, houses, stocks, bonds, commercial real estate, private equity. The prices of those assets go up. People who already own assets get richer. People who do not own assets, people who depend entirely on their salary, fall further behind because the things they need to buy to build wealth, houses, investments, are now inflated beyond what their salary can reach. The salary earner is running on a treadmill. The asset owner is riding an escalator. Both are moving, but only one of them is getting anywhere.
For a long time, this dynamic was partially hidden because even though wages were not keeping up with asset prices, consumer goods were getting cheaper. Globalization happened. China joined the global trading system. Hundreds of millions of cheap workers entered the global labor market. The cost of manufacturing clothing, electronics, furniture collapsed. So even though your salary was losing ground relative to assets, the stuff you bought at the supermarket and the shopping mall kept getting cheaper. The treadmill felt slower than it actually was. Then, 2020. The pandemic broke the globalization machine.
Supply chains collapsed, shipping costs exploded, factories closed, goods stopped moving, and governments, responding to the economic crisis, injected trillions of dollars in stimulus directly into economies worldwide. The result was inevitable. Too much money, not enough stuff. Inflation returned. Not the modest, managed inflation of the previous decade, real inflation, the kind ordinary people feel immediately. Grocery bills up 30%, energy bills doubled, rent increases of 20 and 30% in major cities across the world. And then the response. Central banks raised interest rates rapidly to kill inflation, which worked, slowly, partially, but with a brutal side effect. Higher interest rates made mortgages dramatically more expensive. The people who already owned homes, sitting on decades of asset appreciation, were largely insulated. The people trying to buy their first home, suddenly facing mortgage rates 3 times higher than 2 years earlier, were locked out completely. The gap between salary earners and asset owners, which had been widening for 50 years, suddenly snapped wider almost overnight. And here's the part that reveals the whole system for what it is. During this same period of high inflation, the period when ordinary people's purchasing power was being crushed, corporate profits hit record highs. Record highs. Companies did not absorb the rising costs, they passed them on, and then added extra. Economists gave it a polite name: greedflation. The practice of using an inflationary environment as cover to raise prices beyond what cost increases actually justified. Because when everything is going up, who is going to notice one more price rise? The answer? Nobody, because nobody did.
So where does this leave the salary earner in 2026? It leaves them in a structural trap. Work harder, produce more, the productivity gains go to shareholders. Save money, the savings lose purchasing power to inflation. Try to buy a house. Asset prices have been inflated beyond salary reach for a generation. Try to invest. The stock market rewards people who already have capital to deploy, not people living paycheck to paycheck. The data tells the story clearly. In 1980, a median-income American could afford a median-priced home while spending roughly 30% of their income on housing. Today, in most major cities, a median income does not qualify for a mortgage on a median-priced home at current interest rates, not even close. That is not a market correction waiting to happen. That is a structural reality that took 50 years to build. And it is not unique to America. London, Sydney, Toronto, Lagos, Nairobi. The same pattern plays out across every economy integrated into the global financial system. Salaries connected to labor markets, asset prices connected to financial markets. 2 different systems moving at 2 different speeds. One of them winning, one of them losing. And you are almost certainly on the losing side unless you own significant assets.
Here is the truth that most financial advice deliberately avoids. Saving harder will not solve this. Budgeting better will not solve this. Cutting your morning coffee will not solve this. This is not a personal discipline problem. It is a structural system problem. The gap between wages and inflation is not an accident or a temporary malfunction. It is the predictable output of 50 years of policy decisions that consistently prioritized asset owners over wage earners, tax structures that reward capital gains over income, monetary policy that inflates asset prices, trade policy that suppressed wages, corporate governance that redirected productivity gains from workers to shareholders. Every one of those decisions had winners and losers. The same people kept winning. The same people kept losing. Understanding that does not fix it immediately, but it changes what you do next. Because if you understand the system, you stop trying to win by following rules designed to keep you losing. You stop saving in cash that inflates away. You start thinking about how to own assets rather than just earn income. Not because the system is fair, but because the system is what it is. And the first step to navigating it is seeing it clearly.
So here's the question. If wages were deliberately decoupled from productivity 50 years ago, and the system has been working exactly as designed ever since, what would actually have to change for your salary to finally beat inflation? Drop your answer in the comments, and share this with someone who just got a raise and still cannot figure out why they feel broke, because the answer is not in their budget, it is in the system. Subscribe. New video every week.